The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You are listening to Money in the Morning with Mitch Goldberg. I'm Mitch. Thank you very much for joining us. We are at Friday, so welcome to the Friday edition. Happy Friday. I wish you all wonderful good plans for the weekend. This is a holiday-shortened week, so we're talking about the market first. And even though it's Friday, the market was closed on Monday. But damn, this week does seem like a really long week for the market. And that's probably just a guess because it continues to go down. So as you and I speak, the futures on the Dow are indicated to be down 375. So looking like a down 400-point open. That is 1.16%. S&P futures down 52 points, about 1.3%. NASDAQ down 210, about 1.75%. Oil barely up 16 cents a barrel. Today's move in the market really has nothing to do with specifically with the price of oil. Yields are up. The 10-year continues to hover in the 3.9s. I shouldn't say this publicly on radio, but I think I'll eat my hat if we don't see the 10-year at 4%. How about that? Oh my God. I know somebody's going to come in my office with a hat. Okay. When it'll hit. Okay. I'm giving myself unlimited time now. Okay. So I'm giving myself, 100 years. No, but I do think that'll be at 4% very soon. Heading into today, just for the first 3 days of the week, the S&P was already down 1.6%. So we're looking like we're going to have a close to 3% down week in the S&P. Dow is down about 2% heading into this morning. So that'll be down about 3.25% as of now. And NASDAQ futures, down a lot. So we'll probably see about a 3.5-4% down week for the NASDAQ. Just to put it in perspective, we are rapidly giving up the gains for 2023. And it's all because of today's figures. The PCE came out this morning. Okay, this is key inflation data. All right, the core personal consumption expenditures price index was up 0.6% for the month. That's 1/10 higher than expected. But for a year, it was 0.3% higher than expected. And we're just not getting the break. It appears that inflation is accelerating, which makes sense to continue from that riff we've been on from the last employment report from January. 517,000 new jobs created. Yesterday was like the 5th or 6th week of below 200,000 first-time unemployment claims. So that means fewer people filing for unemployment claims because the labor market continues to be so strong. So people are still spending, and the consumer, I'm talking on the aggregate. I know we could all find individual examples of a weak consumer, but on the aggregate, retail sales, which were weaker than expected over the holiday season, rebounded a lot in January. And all of these numbers actually make a lot of sense. So here we are with inflation continuing to beat the stuffing out of the market. But we must stay focused. We must understand that these are trends and inflation comes and goes. There's lots of reason for inflation. And it's people like to put simple reasons to help explain things to themselves. That's a form of control. We like to think that we have control over our lives, but the market imitates life, or does life imitate the market? We don't have control like we think we do. All right, so but I'm getting a little philosophical on you on a Friday today. Today is also the 1-year anniversary of the start of the war in Ukraine. I glee every time Ukraine has a victory on the battlefield, and I support Ukraine. Just I do, and I really hope though that we come to a peaceful resolution. But everything I see does not look like that is happening. But it does give us a moment to, because we're talking about money and investing, to look at defense contractors, okay? And the ones that I follow the most are Northrop Grumman, Lockheed Martin, and Raytheon Technologies. And in the last year, the Northrop Grumman is up 23%. And Lockheed Martin is also up 23% in the last year. And Raytheon is up 8% in the last year, while the S&P 500 is down. What am I saying? It's down 5%. By the way, you cannot invest directly into an index like the S&P 500. You can only invest in a security or a fund that tracks or mimics the index. So anyway, I don't want to make this a call. I don't like to give buy recommendations on a stock or a sector on the show, because I don't know the personal financials of the person listening. I mean, I feel like I'm getting to know you all, but on an individualized basis, which I would love to get to know you. By the way, if you want to learn more about me and you want to follow up with a one-on-one conversation, just check out moneyinthemorning.info. And, you can reach me through there. My contact information is there, and I'd love to speak with you. Sometimes people call to say hello, which is really cool. Sometimes people call me to say they're enjoying the show, and there's other questions that they have, which I love, because that means other people are thinking about that. So it gives me something to talk about, and it gives me more content that I think is more relevant to you, the audience. And some people just have a basic personal finance or investing or planning question, and they go their merry way. And out of those people, sometimes people want to explore a deeper financial advisory relationship with me. So if you want to take this conversation offline, one-on-one, hit me up. Go to moneyinthemorning.info. Okay, so as far as the defense contractors go, I look at the conditions that drive trends, which drive securities. And to me, the trend of China, an emboldened military power and a strong military power, and Russia as a resurgent or a wannabe resurgent military power, and other companies all of a sudden spending money that they never thought they would be spending again on defense products, like Japan. India is a huge spender also. The trend is in place for gearing up with military hardware and technology in a world that seems to be more insecure, more defense insecure. So I think the trend of defense spending not only continues, I think it accelerates. Now, this does not mean that you buy these military defense contractor stocks and they go up immediately. They could have big swings. These are still stocks. Stocks could go down a lot, even when the underlying reason that you bought them for is still intact. But if the reason is still intact, that's what gives me confidence to hold a stock through a down market, through a drawdown when the stock goes down a lot. So you have to make up for yourself if it's good for your personal finance and if it helps you meet an objective. All right. So I don't like the objective just to make money in the market. I like the objective to say, I want to make X amount of dollars to retire in X amount of time and to live off of X amount of money for the rest of my life, which could be 30 years or more. That's more, I think, a better objective, and I could plan based on that. So these are the things I talk to people about all the time, and I just want to bring real-world, practical conversations to you, the listener. Thank you so much for joining us. You're listening to Money in the Morning with Mitch Goldberg on 103.9 FM, LI News Radio. Please stay tuned. We've got some really good things to talk about on the other side of these messages. The show ain't over yet. It goes on. We'll be right back. Thank you so much for joining us. We here at Money in the Morning with Mitch Goldberg appreciate so much you're taking the time to tune in. I want to send a shout out to my executive producer, David Levenstein, and to my producer, Sebastiano, whose last name I will not use on the show because I don't know if he's comfortable with me doing that, but he does an incredible job keeping me on track, whispering into my ear, and keeping me confident, and giving me always good, honest feedback. Thank you, Sebastiano. One of the things that we get wrong about investing is the most basic thing. And to me, if you have the basics down in investing, you're pretty much on your way. But people are focusing on, the most esoteric things. They're like, what's the next cryptocurrency? Or, what's a good pot stock? Or remember when fracking was big, people were buying Chesapeake Energy and other natural gas fracking stocks against my better judgment. And, they were doing that, and they got wrecked. The pot stocks got wrecked. The crypto stuff just got mauled. And, and it's, so that's not the basics. The basics are boring. People are trying to find the next hot thing to make up for their lack of basics through the years. And I'm sorry if that insults you. Some of you viewers are going to be like, hey, I resent that. Or some of you are going to be like, hey, I resemble that remark. I'm not trying to throw shade at you. I'm really not. I'm telling you what I see in the real world. And I want to give you this basic. Diversification. That's the strategy we use to mitigate risk. It means a lot of things. It doesn't mean your portfolio won't go down in a generally down market, but it means a couple of things. So I'll start by asking you this. Or I'll start by saying this. If all of your investments are going up and down at the same time, you're probably not properly diversified. Think about that. Diversification means investing knowingly that some of your holdings, whether they be sector funds or index funds or individual stocks, you have to accept from the beginning that some will be down. Like you actually have to actively buy something, invest in something, and actively accept that it'll go down. That is what diversification is, because over time, we expect our investments to all do well, but they will do well at different times along the way, along your journey. If you recall, during the peak of the pandemic, oil per barrel, the price of oil, not only did it go to zero, it went to negative. So if you owned oil, you couldn't sell it to somebody. You actually had to pay somebody to take it off your hands. And leading up to that point and a little after that point, oil, energy stocks were very underrepresented in people's portfolios. People didn't want energy because the performance was lousy. And now you look at energy and investors are like, they can't get enough of it. And they're playing catch up. And that's what's wrong with missing the basics of diversification. Now, when it comes to the stock market, there are 11 sectors of the economy, according to McGraw-Hill. McGraw-Hill is a company that owns the trademark S&P. They own Standard & Poor's. So they say the economy has 11 sectors, and there's financials, energy, materials, industrials, consumer discretionary. But the consumer discretionary are things you want, not that you need. Okay? Harley Davidson, Tiffany jewelry, those are discretionary. Consumer staples is another sector, and that's the things you need. Like they say toilet paper and toothpaste. Okay? There's healthcare, there's utilities, there's technology, there's real estate, and there's communication services. And I'm not saying you have to have all 11 sectors. By the way, if you want this list, the way I follow these sectors is I follow the corresponding exchange-traded funds for these. The SPDRs, the State Street S&P Depository Receipts, also known as the SPDRs for the retail investor. There's 11 of them. I have a list of them. I look at them every day. I think this is more important for me to look at than the S&P, the Dow, and the NASDAQ. If you want this list, reach out to me through moneyinthemorning.info. I have to I'll email it to you along with our Reg BI required disclaimer that we have to send to everybody who we have a one-on-one conversation with about investing. And I'm happy to send it to you. And I'll happy to explain how I use it. But some of these sectors are defensive. And I don't mean defense contractors like military hardware. I mean defensive meaning that when the economy gets weak, defensive companies hold up better, like consumer staples and healthcare and utilities, because you have to spend money on the corresponding products, regardless of whether or not there's a recession. If there's a recession, you're still buying toilet paper. All right? You're still buying medicine. All right? So those are defensive in nature. And then there's cyclical sectors, which do better when the economy is strong. They do worse when the economy is weak. And they do really, really badly when we're going into recession and even when we're in a recession. Well, it makes sense that they do really badly when we're in recession, but they do start to turn up often before the end of a recession. But that's more of a trading thing than what I'm trying to explain here right now. So when you have individual stocks, you should make sure that you don't have five great companies like Apple and Facebook and Amazon, right? You know the companies I'm talking about. But I just have to say, when I say great companies, these are good companies. They're great companies. But this is not a stock recommendation, because I just know that my compliance team would be like, was that a recommendation? No, it's not. They're great companies, though. Please, humor me here, okay? The problem with just having those, what we consider the popular companies, is that they all trade up and down together. They're what we call correlated. They go up and they go down as a group. So in that sense, even though they're different stocks, You're not really diversified if they all act the same. To be diversified, I want to see stocks and sectors that act differently. So instead of having Apple and Amazon and Alphabet, which is Google, maybe you could have a consumer staples company instead of one of those, maybe a Procter & Gamble or a Pepsi or a Coke, something that acts differently, and maybe a bank stock. That's how you achieve diversification, either through sectors or individual stocks. And if it's not something you're interested in doing, then there certainly are more generalized funds to take advantage of. So there's a flavor for everybody. I cannot believe I hear the music. It's just, the show goes by so fast. I'm going to have more on this on Monday. Hey, everybody, have a great weekend. Thank you so much for joining me. You're listening to Money in the Morning with Mitch Goldberg, moneyinthemorning.info. That's .info on 103.9 FM, LI News Radio. Please stay tuned for more homegrown programming. Have a wonderful weekend, and thanks again.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. ClientFirst Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and ClientFirst Strategy and not those of Next Financial Group Incorporated. The views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions expressed